So, we've looked at this a few times in the past, but ideally, one of the major things that we're looking at, and I want you to highlight for yourselves, is of course this big gray box. This big gray box was a recession from 2000 to 2009. It was an expanding flat. This is the same type of structure we're watching in the Aussie yen right now. That Aussie yen is 3 waves back in an expanding flat structure. Okay, that's low, new high, new low. That 3 waves back also happened to be, if you drew from the lows or the all-time lows, go all the way back, draw from 0 if you want, because logarithmically it's effectively 0. If you draw all the way back to the Great Depression lows, to the highs of that time, this was a 50% pullback. This is that 50% right into the 791s. And if we had gone below the 606s, we would have broken that long, but it didn't happen. And the market traded up to a negative 23.6 line. So even on the grandest of scales, multi-generational scale here on the S&P 500, the market traded a 50 back to a negative 23.6% target. We know from what we look at every day, right, that once a market has gone from entry to target, the next in series is drawn from entry lows to target highs, and that is the, well, in the cash here it's the 1400 level. In the futures, that was coming in at 1340s. But it's such a minuscule difference, you can see where 1350s is on this chart. It's a very small difference, considering our stops would be well below the 1200s. So, I mean, that's a huge daily level. I'm not saying we're going there just yet, but if we're going to do a 3-wave pullback, this is about as good a start as we've had in a long time, at least since 2012. But this is still just a pullback. So, don't be surprised by it. Now, and one of my more favorite things here is take a step back for a moment. Let's go back in time, 40 years, 30 years, to the 70s, the last major recession we had. And what is the most amazing thing is this gray box. The same recession over the same number of years gave you the same 3-wave expanding flat structure, and drawn from entry or from lows to all-time highs at that time was a 50% long at the 62.87s. It traded, and the rest was history. The market then rallied up into its negative 23.6% targets. And upon rallying up, about this time, let's see, recession lows were in 1975. Highs before that first major pullback were in 1981. That's 6 years after the recession. Well, I'll be damned if we're not 6 years after the recession here. 2009 to 2015, guys. And we're starting to get that big pullback. I'm not saying we're going to get that big 50 back down to the 1400s just yet, but this is about the time that the market started that same pullback right here back then. Now, I've been tracking this analog for the better part of 5 years now. We discovered it back in 2010. Or I discovered it anyway. And I've been talking about it for this whole time. I can show you YouTube videos going all the way back. It's pretty cool, right? Now, the other kicker in the hole here is this 50-month MA and the 200-month moving average. This is an important technical because if we take that technical all the way back to the Great Depression, since 1946, when the 50-month moving average moved back above the 200-month moving average, these are just two moving averages, they have never crossed back over. They came really close in 1979 or 78, 3 years after the recession lows. And they came really close again in 2013 or 2012, 3 years after the recession lows. Amazing. but markets happen for a reason. And we absolutely can, to me, I can't ignore this sort of thing. But I find this to be very cool. I find it to be one of the most amazing features of the market today is that, to be quite frank, the S&P 500 is completely repeating its last great recession back in the 70s. Price action has been almost tick for tick, move for move, oscillation for oscillation the same. It's taken the same amount of time to rally up into the highs that we have, the 6 years, and then we got a big pullback. Whoops, let me go back to the 1970s to show you how the pullback that we got in 1981, I wasn't even alive then. That's crazy. Not to make other people feel old here, but that's the truth. It was a full 50% retracement at that time. And that's why I cited that 1400 level, because it pulled back from recession lows to the highs into a 50% pullback. And if that happens again, guys, to me, it's the last opportunity before the great inflation occurs and markets run away for the next 20 years. Let's see. Not saying, just saying. The S&P 500 is definitely something that has been unbelievably technical, unbelievably patterned, and when you step out to that grander time frame, those patterns and those trends still exist. It doesn't matter the time frame you're trading. It doesn't matter what you're looking at. It's almost like the bigger the time frame, the better it is. So quite amazing that if it walks like a duck, it quacks like a duck, it's probably not a moose. And I'd have to say that this has been a absolutely unbelievable fractal pattern that's playing out here. It blows my mind. I can't even begin to describe how amazing it is. It has been to watch this play out over the last 6 years. And so from time to time, I bring it up and we talk about it. But it's it's there. It's real. It's a major part of what is driving price action today. For whatever reason, I don't know why, but I am amazed by it, I'll tell you that.